Good afternoon. Welcome to the TheoTRADE evening video. I am Blake Young. Today is August 10th, 2023. Today we ask the question, is it inflation, disinflation, or misinformation? Today CPI reported and showed that we didn't have really a change of any inflation data. It showed as expected, but is that accurate? Is that the right information that we're getting from the charts? Is that what we're getting from the data that was released? And we're going to dig into that a little bit today to show there's more than meets the eye. So to start out with, we'll just talk about the SPY today. The SPY gapped up, tried to close up higher, but failed and came back down and is currently about to close near the lows in yesterday's close. As we're watching, inflation is still on the rise, showing us there's uncertainty, putting pressure on the markets, and we could have some additional downside. I've been watching for this 430, at least in the near term. Now, getting into inflation. Inflation data, according to CPI, CPI is Consumer Price Index, and Consumer Price Index is the measure of what does it cost for consumers. GDP, Gross Domestic Product, or what we produce in the United States, is about 60 to 65% consumers or consumer pricing. And so for watching consumers, we're getting a big picture of what things cost for the entire economy, about 2/3 of the economy. CPI is a critical bit of data. It shows us really what's going on in cost inflation. But again, there's more components than just that number. So if we look at the report today, you can see here's the CPI data. CPI in the US shows that we came in at 3.2%. That is less than expected. And everybody's going off that, oh, well, if inflation is less than expected and only 3.2%, then that must mean that we are seeing disinflation. And if disinflation is occurring, a slowing down of inflation prices or rising inflation prices, if disinflation is there, then we have no need to raise rates to get inflation under control. But there's more information just with the top level, and then we're going to dig into the subset. Number one, a 3.2% inflation rate year over year is telling us that we're at 3.2% higher than a year ago. It does not say that we are lower compared to the year before that. So as an example, and I've made this example with cars today in the main room chat, but if you're driving 90 miles an hour in year one, so 2 years ago, you're driving 90 miles an hour and you see a 10% increase in your rate of speed, your inflation rate or your acceleration sees 10%. That means that year you'll go from 90 miles an hour to 99 miles an hour. And then if this year we are increasing at 3.2%, even if it's lower than analyst expectations, that 3.2% higher rate, again, assuming the 99 miles an hour rate that we're going at, that is the rate that we're traveling at now. We're still accelerating at 3.2%, which means we're going at 102 miles an hour. Yes, it is slower acceleration, so we're not further increasing the rate at which we're accelerating. We're slowing the rate at which we're accelerating, but from 2 years ago, we've gone from 90 to 102. So even though it's slowing its acceleration, it's still accelerating. And number two is it's still higher than last month's year over year. Just because we missed analyst expectations does not mean that this was not a bump up in inflation data. If we look at the inflation data here and you look at the chart, we were seeing it slow down, slow down, slow down, acceleration slowing down, and then we actually bumped up. So the only time that we can trust that this declining CPI is a true indication of balanced or managed growth is if growth is climbing at the same rate or faster than this is declining. So we'd want to see GDP in the 3.8% or the 3.2% rate to really see that this is okay, that 3% is acceptable, and the net inflation versus the net growth is saying that we've got inflation under control. And that's not what we're seeing in this chart. Additionally, we had CPI come out of China. China reported a negative 0.3 year over year CPI and a negative 4.4% PPI. Now, you might think that if high inflation is a problem, then negative inflation must be a good thing. The problem is that negative inflation hurts borrowers. It means that you will be paying back your debt with higher costs. You'll be paying back your debt with more expensive money. And so deflation and disinflation, disinflation meaning we've gone actually truly into the negative. Deflation, economists don't like using that word, but I think deflation is real. You have to truly go into the negative month over month and year over year to be able to get true deflation. So they usually call it disinflation. This deflation or disinflation move is a very bad thing. It's a very strong indication of recession. The only time we get deflation and disinflation is strong recessions and even during depressions. So this negative 4.4, previously is 5.4, you can see a lot of negative through here. We had the disinflation and deflation in China. When did that happen before? It happened again in 2019, 2020 during the lockdown. You go back prior to that, you can see back through here we had a long stretch of deflation, and China struggled during this time frame. And then when was the prior? During the recession, the Great Recession of 2008, 2009. But let's look at some other data that can help us out. Let's go to the charts. And I will show you this technique so that you can do this yourself. But what we're going to do is we're going into studies, and we're going to do what is considered a risk-free premium-based inflation chart. Now that sounds like a lot, so let's just go ahead and put in a price ratio. What we're going to do is we're going to put in a price ratio, and we're going to compare a commodity to bonds. Because bonds are supposed to be the risk-free premium approach to the market. If bond prices are holding up and inflation is going up, then that's fine. They're relative to each other and the movement can be measured. But what we'll do is we're going to start out with the number one inflation measure, which is gold. And we're going to compare that to the long-term bond. We're going to do the 10-year. You could do the 30-year if you'd like. I think 30 years, some people feel that that is a better indication. I think 10-year is better because this is where your business debt is usually tied into, 7 and 10 years. So we're going to do gold versus bonds. Now, if you hit OK, we're going to draw this on the chart, and we're going to look at this lovely little number. And this is showing us whether we have inflation or deflation, disinflation. As you can see, we've seen higher prices, higher highs, higher lows, higher highs, higher lows, reaching all the way up here in April. And as we look over here, we did create a little bit of a pullback, but is that not inflation? In practical terms, however, we don't measure inflation based off of daily moves. We base it off of multiple weeks, months, quarters, even years. So if we go back to the 3-year weekly, just so you can see where inflation is, inflation based off of week to week, and you can look at our indicator down. By right-clicking on it, you're going to see the blue line is 4 weeks, so it's a rolling month. And the yellow line is 40 weeks. So call it 9 months, 10 months worth of time. So we're watching this. We're looking at the move from a week-to-week view, and it gives us a little bit of better picture of what's going on. This is the highest the inflation has been, at least comparing gold to bond prices. Highest the inflation has been during the last 3 years. Look back further at other times that have been critical when it comes to inflation and growth and recession. If we go back 20 years, and we can leave it on the weeks, and we compare the inflation data, this is the highest inflation has been in 20 years. If we go back and go ahead and put on the max available, you look here, and it's the highest level going back to 2003, because that's as far back as we can go on the gold and the bond futures. That does not mean that it's not the highest. We know that inflation is and has been at the highest level it's been in 40 plus years. So as we're looking at this inflation number and we're seeing it makes higher highs and higher lows, yes, we are slowing down how fast we're climbing. The slope is slowly mitigating, but it's still rising. We're still seeing significantly high inflation. If we're to watch this forward, and I think we need to slow that down a little bit, we could go out and push this out to 50. We can get a little bit longer time frame and create a moving average that is going to show a bounce off of that. And this is 1 year if we go 52 weeks. At 52 weeks, we can see a sense of what is inflationary and disinflation when we cross through that 50-week average. Little pullbacks don't mean a lot. We're still making higher highs and higher lows. We're looking for a close below this line. So until we get down below here, I don't think we've got inflation under control. If we look back to the previous times, we oftentimes forget that we had a pullback and in the Russell and some of the indexes in 2013, 2014. In 2008, 2009, we pulled back and crossed through there, showing disinflation, deflation. And all that quantitative easing spending can be seen right through here. So until this is under control, I would not expect to see a real change in what is going on with inflation until we see it cross back down and move back, at least back down to 16, if not below 16. We have rising inflation, and inflation is continuing to push higher and higher. Now, we could compare this, instead of gold to bonds, we could compare copper to bonds as a true indication of not just inflation, but as an indication of growth and demand. So putting in copper here and comparing copper to bonds, that'll give us a little bit different story. And we end up getting a chart that shows us growth in inflation versus disinflation, or in other words, stagflation. So if the one is rising still while copper is breaking through the yellow, that would be your indication of stagflation and lack of demand, lack of growth. You can see that we fell from about end of 2011 all the way to 2016. And so if we're watching this, we're looking for similar pullbacks, we're looking for the corrections that move through here in 2013. And this move and this correction here, notice that we crossed down in 2018. We made a high, but then we reversed and fell almost 12-15%. And back in 2008, where did we cross? The true demand and the change there. We crossed down here near the peak. We crossed back up, crossed back down again, showing that inflation, or growth-based inflation using copper, was over. And we continue to fall from 126 all the way down through here to 67. So we got another 50% cut after the initial move, and we also were kind of warned that this was coming. So if we're looking at that as an indication, we've already seen the warning last year, and now we're approaching the cross down again as far as growth-based inflation. It may not exist anymore. I pulled up the CPI based on the Bureau of Labor and Statistics website. This is Bureau of Labor and Statistics website. And looking at the previous month, you can see 0.2, 0.2, 0.3. These are all the inflation areas. Food still climbing, food at home still climbing, food away, restaurant is rising faster. And if we look at energies up 0.2, sliding down, fuel oil is up 3%. So a lot of the pullback from the previous year has been in fuel oil, and we've already seen a rise of 3% based off of the fuel oil data. And the year over year is still showing negative 26. That's not realistic. If we look at fuel oil and retail gas prices during the same time frame, gasoline, are we down 20% from a year ago? Are you seeing your cost, if you're paying $5, you get $4. If you're paying $4 a gallon, are you now paying $3.15? And reality is no, it's not happening. We can look at the retail gas prices. One of the biggest movers this month is used cars are down. That's it. That's really the only thing that seems to be significant. Electricity is down 0.7, but the only one that seems really significant is that used cars are down 1.3%. So unless you're going out and buying more and more used cars, that's not going to help you, even though it will push the CPI numbers down. I like this chart, and I'll show you this one, because this breaks it down a little bit better for us to show us where the increases and decreases have happened. Motor vehicles down, or motor vehicle insurance is up 17%, while motor vehicles themselves are down. If you look at here, it says that health insurance is down 30%. I'll ask you the same question. Is that what you're seeing from a year ago? Have you honestly seen a 30% correction, lower cost in your health insurance? I have not heard anything close to that. I have not heard any even suggestion that health insurance has dropped pricing. Whether there are new policies that are coming in cheaper, I do not see it as a third less. And we look at some of the other ones that dropped it, which would keep inflation under check. Gasoline, again, regular. Airline fares, that one may be legitimate. But we're paying motor vehicle insurance. We're paying for repairs. We're paying for vegetables. We're paying for bread. We're paying for poultry. We're paying for all of these things over here. And realistically, we're not seeing that 30% decrease in health insurance costs. I don't know of anyone. If you are the person outside of that, send me an email. If you are the person that has seen a 30% decrease in your health insurance, let me know if that's the case. If you've seen a decrease of 20% in gas prices, let me know, because this doesn't seem right. This seems to be disinformation or misinformation that we're reporting in this chart. Almost all of this we can confirm. That is valid. Medical care services down 1.5%? Maybe. Possibly. It is this one that seems to be the outlier and not accurate. And unless you think I'm making stuff up, I just want to show you this really quickly. According to CPI, CPI said that retail gas prices, gasoline prices, were down 20% from a year ago. This is the retail gas futures chart. That's it. I mean, to me, there's no question that if you look 1 year ago today on the open, you would be looking at a 2.4 futures price. Add in your state and local taxes here and your federal taxes. That will give you an idea of what it costs to pay for at the pump. And so if we assume about $1.60, it was $4 a year ago, and today it's $4.90. If you're seeing about $1.60 in prices there. Now, we might need to include a little bit more time to see what it was like in July. But even July, if we go back to July of last year, we're still up from July a year ago. If we're reporting July to July, prices are still higher. Not down 20%, up. So what does that mean? In the end, we could ask the question, who cares? Who cares if what I'm saying is accurate? Who cares if all this information is true? Where do we find our opportunity? Generally speaking, if we are headed into disinflation, generally speaking, you should expect to see the US dollar or the currency of whatever country you're involved in. If your country is going to experience disinflation, generally speaking, the dollar or its currency should gain. And so we might be looking for long dollar positions in the dollar index and UUP and pushing these things higher. But that's also about the same time that we should expect to see a base in bonds and bond prices. So as we're looking at bond prices falling, watch for that deflation and disinflation to occur, because that generally is the base of the bond market. So if we have the opportunity to potentially buy down here and we see it move back up to where it was before, the opportunity gives you an opportunity to buy bonds at a high interest rate, high yield. And if we return to what we saw a year ago, if disinflation or deflation did that, that means you would get your 5% yield plus a 20% increase in value of the bonds. Well, I'm sorry, I looked at 2 years ago. Last year, it would be about a 10% increase. So 5% increase plus 10% appreciation of the bond price if you're not planning on holding it to maturity. So bond prices could be basing out, could be finding a base over the next couple of weeks to month, and bond and the US dollar could be strong investments, while also looking to sell or short equities, gold, and the inflation hedges if we're going to see that deflation or disinflation. Now, I do think that, again, the data is showing that we're not done with inflation. But if we are about to roll over, that we're going to see stagflation and disinflation, then we will likely see the bottom of the bond market. Well, that's going to do it for me today. Thanks for watching. We'll look forward to talking to you again next week. Take care.